The July FOMC meeting is in the books. Jerome Powell has not been fired, and the Fed held rates at 4.5%. Should they have cut rates? Will they cut rates in September? And what do investors need to watch out for as we move forward into the next half of this year? Hello, and welcome to Milk Road Macro, the podcast that knows that asking a bunch of old economists in DC what the interest rate should be makes about as much sense as asking a groundhog how much longer winter is going to last. I'm your host, John Gilden. Today is Wednesday, July 30th. And we are joined by a true macro trading veteran and founder of TG Macro, Tony Greer. Tony has over 30 years of experience on Wall Street as a trader at Goldman Sachs and UBS, and is the editor of the Navigator newsletter that delivers actionable alpha for investors. Today, Tony's going to break it all down for us. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who would enjoy it. And as a reminder, if you are listening to this episode on the Milk Road Show, these macro episodes will soon only be published on the Milk Road Macro channel. So you can listen to our show on YouTube, Spotify, Apple Podcasts, wherever you get your podcasts, but make sure you are following us at Milk Road Macro. We're really excited about this to get this new content out to the community. Today's episode is brought to you by Definitive, the leading multi-chain trading terminal trusted by funds, DAOs, and pro traders alike, as well as Ledn. Get cash without selling your Bitcoin. Without further ado, welcome to Milk Road Macro. Tony Greer, thanks for joining us.
John, thanks for having me, man. I really appreciate it. How you doing?
I'm good, sir. I'm really looking forward to breaking down your thoughts on the FOMC meeting here. So let's just jump right into it with the Fed. We just had the meeting, no rate cuts. Jerome Powell has not been fired. He has not resigned. But the tone of the meeting today was a little bit more hawkish than I think most investors were expecting. We're seeing the market sell off a bit. Your thoughts, initial reaction to this coming out of this meeting?
So for me, it's still all about the dollar. You know that we got the dollar to an oversold condition. Front page news item has been the dollar weakness in the markets, basically all year. I think it reached a crescendo a couple of weeks ago, the dollar index down on a 97 handle. And here we are, attacking resistance on the upside. We got right up to 100 in the dollar index, which is a huge pivotal level for me. If we get back up above the bottom of the old range, we could see a significant move higher, like 4 or 5% from here, just until we get to a point where the dollar is still in a downtrend and can be sold. But it seems like everybody got way over their skis with the idea of, oh, this is an easy year. We're just going to sell the dollar. We're going to buy gold. Silver should catch up. So we're going to buy silver. And, everything metal now is going to be under pressure that the dollar has begun a serious swing higher. And it looks like for equities, it's probably going to be business as usual. I mean, it's the fifth consecutive FOMC meeting without a rate cut or without an action. Bonds could not mean revert to the center of the center of the center of the center of the middle of the range any harder. Like bonds will not move, and people don't understand how bullish that is for stocks. I mean, I think it's a testament to the fact that the stock market, went down, 75 points after the FOMC and came back 100. You know what I mean? Like there's no selling. There's really no selling in the stock market. That's not really where the risk is. I think that the risk is in things like the dollar and gold and everything that's tied to that trade right now. So without going on too long without letting you speak, John, that's kind of where I'm centering my focus right now.
Gotcha. Okay, there's a lot to unpack there. I think since you came to the dollar first, let's maybe go into that first. The dollar's down something like 11% on the year. Bank of America had some reporting last week, I think, that shorting the dollar is the most crowded trade in the market. Do you think that this is going to continue in the second half of this year? Everyone's going to stay crowded into that trade, or they're going to unwind that? And like, what's been driving those views that people have been taking in the market on that?
Well, the dollar's only down 8% on the year now, just as a testament to how much it's bounced. It's bounced quite a bit off of the lows. I do think that this is literally, like any other market, a sentiment and positioning washout. Right. I think that the down dollar move is probably the right thing. I do believe wholeheartedly that President Trump is going to get interest rates much lower. Right. I mean, he's just running into political static right now, like not allowing that to happen. He can probably make a good enough case that there's no inflation and rates should be lower just to help the housing market. And that's what he's going to do. I think that he realizes how good that is for the economy, and he's going to make that happen come hell or high water. So if we get there in a direct path or not, what is in process of happening with the dollar is the last shorts into it are being forced to get out on a technical basis, right? So I do think we're going to get more shorts out. I think there's a lot more to go on the upside of this retracement trade. And then when everybody says, you know what, I guess the dollar's not going to have that terrible a year, it probably resumes its path back down. But to me, it did become like a front page sentiment issue. I mean, I had guys that I stay in touch with that are college lacrosse players from Cornell reaching out to me, literally weeks ago saying, wow, this weak dollar is really something, isn't it? And you're like, wow, I didn't even know that you could find the dollar price on the screen. But obviously, the dollar weakness has made it all the way to your locker room at 19 years old. So sure, let's talk about it, So I mentioned that when I said that the dollar was done going down because sentiment had gotten way too lopsided based just on that story. So now we're just seeing, the technical comeuppance. It's got gold. Gold is backed off, if you notice, very quickly from the 50-day moving average at 33.50 to the 100-day moving average at 32.75. It's going to go very quickly now to 3,000 to the 200-day moving average. That's the move that's set in motion. That's basically locked in a box for me. Like if you notice, we made the high in gold in May when the Barron's cover printed gold on the cover with all those nice gold bars in the picture there. They were perfectly set up on the cover. We never traded higher, not another dollar higher than the weekend that Barron's cover article came out. And then we put in 3 failed breakouts, 3 peaks at 34.50. And it amazes me that the people in the gold market, they stay bullish. Right through all of that. Barron's cover, don't care. Triple top, don't care. Pull back through the moving averages, don't care. And what they're going to not care about now is when their P&L goes down. I don't know, it looks like gold's got another 10% to go down. So they're not going to care about their P&L going down 10%. And then we'll see what happens because maybe it really slides from there, who knows. But everybody is just as too confident in the long gold trade as they were in the short dollar trade. And that's the unwind that's been set in motion now. If you ask me, with rates continuing to try to mean revert even harder and not move, that's just going to spike the equity market that much further. Gotcha. And there may be weakness in materials and metals and mining. I understand that. If rates even just stay around here for now, the equity market's going to be just fine and cyclicals are going to come alive. The economic data has been mediocre, not terrible, not recession-y. And so all of that is just enough to keep rates range bound and the bull market and stocks intact.
Gotcha. Okay. Yeah. Appreciate the thoughts on that. I think I want to come back to something you said at the beginning, which was one way or another, come hell or high water, Donald Trump is going to get lower interest rates here. I think, coming out of this meeting, something that stood out to a lot of people, we've had 2 governors of the board at the Fed dissenting on this in favor of a 25 basis points rate cut. But yet Powell in his remarks said that he says we have a strong economy and a strong labor market. Walk me through the thought process on why is it so important to get a rate cut right now at a time when we have the economy that's strong and, as you said, a market that's going to go much higher. Like, walk me through what you're seeing that would drive that rationale for a rate cut right now.
Oh, I really believe that it's home affordability in the US and how we've reached a point of complete unaffordability to buy a new home, right? Like the median age of the home buyer in the United States is now like 50 years old. You know what I mean? So the next generation that Trump would like to get on his side, whether he has or not, I'm sure he's got some of them on his side already, but I think he wants to get the rest of them on his side by making their lives easier. And I think that one of the reasons behind why he's pining so hard to get Powell out, to do whatever it takes to get rates down to 1 or 2%, is because he can see that housing affordability slipping away. And I don't think he wants to create a runaway train during his administration. So if he can just stop the bleeding there and kind of cap mortgage rates, God forbid, make rates go down lower, which will stimulate the housing market, I think he knows that will stimulate the entire economy. Right? There's really almost no arguing that when the housing market is strong, the U.S. economy is doing fine. Right? There are very few instances, if any, that I can think of that the housing market is strong, that we're getting, lots of new home sales, lots of existing sales, and the U.S. is going into a recession. Right? If anything, the recession happens first, rates come down later, and then we get everybody back into refinancing and doing that, the home builder trick all over again to spark the economy out of a hole. So I think that that's the rationale behind it, quite honestly, John. There could be I think that Trump is looking at other nations, and just looking at their numerical interest rates and say, I want ours to be that low too. So there's an element of that and an element of the fact that he knows it'll be good for the economy. And quite honestly, I don't know if he knows it or not, but I think it'll be great for the stock market. I think that what'll happen is technology will catch up to all the industrials and the miners and things like that are at the top of the leaderboard on the year, and where technology is really, really dragging in the back seat right now. So I think that if he gets rates lower, housing improves, he gets the next generation on his side, he keeps the economy strong, and he sets the stock market up for another 5-10% rally.
Gotcha. Okay. Appreciate the thoughts on that. Yeah, I think that to me, it's reflective of the administration's pivot from where they started out of like saying we wanted to do Doge and austerity and cut government spending, more towards this new policy of let's run the economy hot, let's grow our way out of this. Obviously, there are risks with running the economy too hot, but I do think you're right on that's kind of a reflection of that change in tone and direction, I guess, of the administration's overall policy. So to go back to some more of this on the administration's policy, Bill Maher recently admitted that he was wrong about Trump's tariffs. And he said that he thought they were going to tank the economy. They haven't. Today at the FOMC press conference, Jerome Powell said that he's still watching to see what inflation impacts that the tariff policies will have, but it doesn't seem like, at least yet in the data, that's had this big kind of like blowout, tank the economy, crushing inflation effect. How do you think about this? Do you think that there's still a lingering risk of a resurgence of inflation from these tariff policies? Or has this mostly just been, hey, we're bringing in lots of new revenue and the economy's just going to carry on and keep humming?
I think the inflation is coming from when the Fed doubled the balance sheet as a result of the COVID lockdowns.
Okay, so you still think
I don't know why. I don't know why. That's what the source of inflation has been. Right. We had to go to war. We had to go to war between Russia and Ukraine in order to get everybody to think that that's why we had inflation. Right. But we doubled the balance sheet in 2021 in response to the COVID lockdown. And I was writing about it back then. Like, this is going to be years upon years of battling inflation. So the inflation hasn't really gone away. Headline inflation is back down in the bottle, which is huge for the markets. What I call grocery store inflation is not going away and may never go away, or it's not going away anytime soon. But as long as we've got headline inflation back in the bottle, I didn't see that tariffs were going to be that inflationary, right? It seemed to me like it was going to be a give and take. So they didn't really so far spark inflation. The reason that everybody thought they were going to not work is because the media is still running the same anti-Trump playbook from God knows whenever they started it. I guess the day he came down the escalator before he ran for office in his first term. But he is still allegedly the DC outsider that everybody wants to stop. So if he's doing something, the media is running a campaign on it being dangerous. I mean, the word choice, down to the word choice, Bloomberg was telling you how horrifying the tariff was going to be, right? Okay, it doesn't look so horrifying here at S&P 6,400, but at S&P 4,800, they were telling me that the world was going to end and the U.S. was going to be uninvestable. They were only telling me that because Trump became president, got into office, and started doing what he said he was going to do. So now that we lived through the 1,000-point down and back experience, which is gone behind us, and we're never going to get that opportunity again, that had to happen that fast, it's time to go back on, like you said, organically growing the country out of this debt and deficit hole, which Besant seems really serious about. And now that we're taking in humongous revenue on tariffs, he's got something to point to. Right. And the world didn't know what that was going to be like. And now all of a sudden we've got hundreds of millions of dollars in tariffs coming in the door. And that, pays for a lot of the bills, covers a lot of the inflation, and the markets are intact. So that's why everybody ran a campaign against the tariffs. And I mean, the Europeans were petrified of Trump getting into office. Trump got into office and they divested from the United States automatically. They didn't look to see how it was going to work out. They didn't look to see what was going to happen. They said, this man is dangerous and I'm going to puke my money into a hole. And that's what they did. And so now the S&P is 1,500 points higher. Nobody in Europe has a stock on their pad. Right. So everybody's got to figure out how to trade this from here, including us. But we stayed bullish. We got long into the dip. We were trading, the necessary sectors that are shooting off in every direction now. And we're managing all the risk, and knock on wood, everybody that's subscribing to my note is doing really well right now.
So I really appreciate the the analysis on that, I think that was something I saw a lot too. Was a lot of the market behavior we saw earlier this summer was driven by sentiment and overblown fears of uncertainty, and we saw the dollar, the U.S. bond market and the U.S. stock market all selling off together, which is like emerging market panic selling type of behavior. What is your view on what the Fed needs to do, or what needs to happen to sort of like bring back the confidence in the U.S. capital markets, to bring back the dollars from Europe? Like,
I'm sorry, I don't mean
it's
to cut
already
you
back.
off.
Oh, you said
Yeah.
nobody has a stock on the sheet. So I was like, how are we going to get them back?
Oh, so what we've got back is we've got market credibility back, right?
Okay.
What we traded through, just like you said, when the U.S. looked like an emerging market for a couple of weeks there with the bond market and the stock market selling off every morning, you were like, what in the actual F is going on here at some level? And that was a crisis in credibility, 100%, right? That was Trump stomping around, throwing the Overton window open to levels that nobody thought were possible. Maybe we're going to do 150% tariff on China, right? Just to get the market scared out of their wits and make the absolute worst things happen in the stock market, right? Once he got that out of the way, we moved to the negotiation phase. And once we moved to the negotiation phase, the tape never looked back. We moved to negotiating from dictating the terms. We went to bargaining, and we went to the negotiation table, and the market said, it looks like he's going to cut a deal here. That'd be great. And then they cut deals left and right, and the tape just kept going higher through the entire thing. And then Trump came out with some executive orders around energy that have been really bullish for various sectors of the market, including uranium, metals and mining, aerospace and defense. This is the new leadership. Right. And this is the new leadership in the stock market, because Trump is rearranging the natural resources chessboard globally, and he's doing it really fast. Yeah. So I think that the speed is what the market can't handle, quite honestly. And I think that what he's doing is going to wind up being effective. And I am not a Trump cultist. I criticize him left and right. But when it comes to markets, I think that he is the most misperceived human being that creates more opportunity in this market than I've ever seen a human being do. So when he became president, I literally told my subscribers, we are going to get our lobster bibs out right now, because President Trump is the most hated person in this world, and he's actually trying to accomplish a lot of positive things for our country. And in the process of that, while they're throwing eggs at him, the opportunities that are going to fall across our lap are going to be unbelievable. Then I bit off more than I could chew, and the S&P went down 1,000 points in my face. Right. So I'm not going to say that I did see that coming, because I didn't, and nobody did. But I was able to maintain the same attitude and say, wait, is this still the same thing? Is this just a pure Trump-besant credibility issue? And that's what it turned into. That's all it was. And we made our way out of that. And so I don't want to beat the drum on this, but I had to make it clear that I'm not just being a blind market bull, and I'm not just being a blind Trump supporter, because I'm agnostic on him, but I know the opportunity that he creates way better than most people.
In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitive, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first 25,000 in volume. Visit milkroad.com/definitive and start trading like a pro today. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn.
Yeah, I appreciate that context. Yeah, I think it's been really interesting to see the markets deal with the uncertainty of having him back in office and the surprise that a lot of people are having around the opportunity that it has created. You mentioned the negotiation phase. A series of deals have been closed with Japan, with the European Union, that are favorable for the United States to a degree that like even his critics are surprised by. We agreed to another 90-day pause with China while we work out those deals there. What is your take on these deals? Are these going to be bullish short term, long term? Who are going to be some of the winners and losers from these? Like, what is your general take in terms of like how these trade deals are going to impact the market and what we should look for who's going to benefit the most there?
So as a trader, the deals came very obviously as the backdrop to stopping the knifing dollar. Right. So that was kind of thing that happened that kind of got clear to me, is that as we're signing these deals, it's like, oh, okay, those are the things that are giving the dollar a little credibility back, or at least lending a bid back to the US currency. We finally got rates out of that, let's call it that credibility issue that we had, and got them back into range. And since we've done that, like I said, it's been pretty much smooth sailing for the stock market. But I think that it's once we got through that that period of just laying down the law on the trade war, right? So I think I got away from the question here. John, get me set up again. What were we just talking about?
Well, just like the trade deals with Japan and the European Union, really positive, and who's going to benefit.
Yeah. So those are the backdrop. Like, I don't know how exactly each of those deals is going to pan out, but when I see the screens, I know that we got a big risk on. Like the dollar was the only thing that kind of risked off to me because that was really intensely oversold. But in a lot of the other markets, we got a big pop in aerospace and defense, a big pop in uranium stocks, a big pop in metals and mining while the dollar's turning. And so all of that was sort of a pivotal. I think that, quite honestly, I think that what I'm trying to say is that those are the headlines that got people to cover their dollar shorts, right? That was kind of what turned the boat to me. So I think that if we continue to see these bargain type headlines and deals and negotiations hit the tape, that's going to be more fuel for dollar recovery, and we're going to get to a point where, it's going to be a massive dollar rally. I mean, we could rally back 50% of the way from the move down from 115 to 97, or call it from 110 to 97, which is a straight line. And that's like 6 or 7 handles back in the opposite direction. So that puts us at like 103. We're still at 99, 90 last. So I think that the more of these deals Trump signs, the more it's going to force people to get out of their dollar shorts and get that dynamic running where the dollar recovers, metals probably back off, and then we see some other leadership in the stock market.
Gotcha. Okay. Well, I appreciate that. That's helpful there. I think I want to look forward now to September. Jerome, true to form, very careful not to give any sort of indication of what the Fed is going to do in September rather. And I think that the market was hoping to get some sort of an indication of dovish sentiment. In other words, like foreshadowing that a rate cut would be coming in September. We didn't get that. In your mind, how important is that? Does it not matter? Is the market just going to run anyway? Like, what do you think about the weight we should put on that?
I'm not taking my eye off of 10-year yields. And I think I stated it, almost exaggerated it too much, that 10-year yields ain't moving, man. Like we've got a massive last 2 weeks of economic data pouring out, from CPI last week to GDP today. And we got non-farm payrolls on Friday, on July 1st. I mean, none of this data has derailed the bond market in any way, shape, or form. There really hasn't been a whiff of inflation in the data. If anything, like you can call it a tick hotter, but I can't call that inflationary, right? So since there's really, the data is in that comfortable place where there's no scary inflation print, there's no scary employment print, right, on the downside where we lost all these jobs or anything like that. So the market's in that phase where we get the recession bros out and we've got their attention because there's not a great acceleration. But then we go and put up a GDP number this morning, and I think this is why rates are a little higher. But we go and put up a GDP number this morning of 2%, 2.5% core GDP, better than 2.3% estimates. Like, that's not too bad. So right. I look at that and, that's kind of the pull to the push of there being no inflation, right? So we don't have inflation. We got no reason to rates spike higher. We got 2.5% growth ex food and energy. It's not great, but it's not falling off a cliff either, right? So there's no reason for rates to tumble into a ditch. And I mean, that's the tailwind of a flat bond market. You know what I mean? Like no matter what comes out, as soon as bonds get away from the center of the range, they go racing back like their hair is on fire. You know what I mean? So until the bond market shows me that it's going to trend in either direction, if that happens, then I'll look at stocks and say something might change here. And I don't know if it's because we're going to get a read on a super weak economy and the bond market's going to rally, or if we're going to get a read on a whiff of inflation and the bond market's going to sell off. But that would get me to sit up in my chair and say, hey, look out, stocks. Rates might start trending in a direction here and the stock market might not like it. If the rates start trending lower, I bet the stock market loves it. If they start trending higher, we probably have a problem and I'm probably going to get flat before you know it. So, I'm not pig-headed about how it's going to go. I'm kind of sitting here waiting to see how it's going to pan out and ready to act either way.
So you're kind of saying you're waiting for the bond market to tell you which direction this is going to break one way or the other.
Yeah. That's always been my thing, John. I'm not an economist and I'm not a good predictor and I'm not great at predicting the Fed. But what I'm pretty good at is letting all the Fed news come out, letting the tape trade and looking to see what the tape is telling me at the end of that day, at the end of that week, and at the end of that month. And that's when I decide how to position myself, when I see kind of how those stars align.
Gotcha. Okay. I want to get back to something that you mentioned before. You talked about Barron's and the front page with gold on it being the local top for gold. I think a lot of our audience may not know what Barron's is, but I do because my father's read it every time it's come out for my entire life. But gold has been in a huge bull run in 2025. And you have been pretty vocal about saying that gold, precious metals are, signaling for a move lower, going back to the bull market support band. What have you been seeing that's giving you such strength in this call for a correction in the precious metals market?
Good question, John. So I got my axe to grind from watching the dollar go lower into, like I said, I'm a big watcher of monthly performance, right? And we had that month of May in gold. To put it very simply, we traded the highs at 3,500 in May, right? Then in June and July, the dollar went lower both months and gold didn't go any higher. And you have to say to yourself, wait, so why is that now? All of a sudden, gold went from 110 to 100 in the dollar index. The dollar index went from 110 to 100. Gold went from, I don't know, what did it go from 2,500 to 3,500 while that happened? And now all of a sudden, the dollar index goes from 100 to 98 to 97 to 97 and a half to 98, and gold can't go any higher. That was a problem for me. And then when you get the Barron's cover curse, which, if you're paying attention to sentiment over years, you know that when something hits the cover of Barron's, that is officially front page news. And there's often some kind of a pullback that occurs later on. And that's what we're finally seeing now. Gold's been in a huge bull market, so there's all these buyers on dips. We've got central banks that were buying constantly and at every price. Then you can make a case, it looks like they stopped chasing gold and started chasing palladium and platinum and silver, right? All the white metals kind of woke up at once. Silver went to almost $40. Platinum exploded, and they got the last leg of the dollar weakness, but gold didn't once again. So I'm saying to myself, silver's going along making a new highs here. Platinum just exploded out of the gate. And where's gold? It's still 3,300. And while the glass half full guy, the guy that's always glass half full in gold, right? The gold bug can look at a glass half full of water and say that's full, right? Because the gold bug doesn't see any negativity for gold. And when it doesn't perform on the upside, that's not as obvious to the gold bugs, right? They just look at the price and they're like, it's hanging in fine. Meanwhile, the dollar's another 2% lower. Palladium and platinum just went up 5%. Silver's on a complete tear. And you're like, no, it's not doing good. It's sitting here, right? And so now we're just seeing that pan out on the downside. And I think it's got another $270 to go to the 200-day moving average at 3,000. And then we'll see. But that was my rationale behind it. It was more dollar weakness and gold couldn't pick its head up. And now there's three tops at 34.50. I don't want to touch the thing.
So do you think that this gold has sort of topped out, or do you think that it'll recover that momentum and continue to accelerate throughout the rest of this year? And how does this macro backdrop factor into that? Or is this more of like a short-term trade in your mind?
I'm wide open. I'm wide open to suggestions, and I'm wide open to, if anything, and this is going to probably get your listeners excited. If anything, Bitcoin looks better to me than gold all of a sudden. And I'm afraid to say that because everybody probably maybe thinks that that's a positive thing. But For me, Bitcoin looked like it was holding its value. I'm a price action and a performance junkie, right? So if the price action and the performance not there, I'm getting out. And Bitcoin to me just looked like it was trading better, doing a better job expressing the death of fiat currency than gold has for the entire summer. And while I started off saying, we're going to have a little pullback here, this is going to be a quick pullback in a bull market, and it looks great. Now I'm a little bit concerned that it spent a full May, June, July forming this top, and a 3-month top in gold, 3-month consolidation, a breakout could put a little bit of a hurting on it to the downside. Now, I don't want to say that the trend is over because I think Trump is going to get rates lower. And I think that might be the thing that adds the next leg onto the gold market. But we definitely have a sentiment and positioning issue up here above 3K. So until we work out the sentiment and positioning issue, I would say that CTA has got red line long gold, and, sentiment was redlined into extreme greed, if we're going to compare it to the CNN Fear and Greed Index or so. And then it stopped going up, right? And then we had the college lacrosse players all texting me about the weak dollar that's all of a sudden on top of their radar screen, on top of lacrosse practice and going out for beers. They want to know about the weak dollar. And that was the tail of the tape. I mean, I did a podcast with Jared Dillian 4 weeks ago. He nailed it on the lows, saying that he saw all the DMARC exhaustion setups in the dollar, and the dollar never ticked lower from there. So I was using that as ammunition on some short metals ideas and the long dollar trade, and that stuff's working out now. But it's the kind of thing, John, I have some idea going in, so I definitely morphed the gold idea from thinking it was a short-term thing to now being a little bit more concerned that gold may not just make a new high for a little while. We may see a real 6-month consolidation. If we trade down to 3K, people are going to have to sell the rally to 3,300 the next time. So that's going to create a little more consolidation. And I think it may struggle a little. So while I say it's not going to be, I doubt it's going to be the end of the bull market, because I think Trump's going to get rates lower and everybody's going to follow suit. And that's a couple of legs of the trade down the road. First, we got to wash out the last longs. First, we got to wash out the weak dollar shorts, and then gold will figure out where to find the next base.
Gotcha. Okay. Yeah, I appreciate the context on that. I think there's just a lot of things that go into these changes of sentiment, changes of momentum, and we're kind of waiting to see some signal changes on gold, on the 10-year, on yields. I'm glad you brought up Bitcoin, because I was actually curious to get your thoughts updated on Bitcoin right now. I think in the past, you've made some comments on it, but I also know you made a really great trade on it, riding it up to 100K. So I would like to hear, has your thoughts on Bitcoin as an investment, or as a trade rather, for the rest of this cycle kind of changed, and where are you right now on that?
So one of the things that's been really impressing me, and the only way that I've latched on to following Bitcoin, is by paying attention to the ETF inflows. Right. I'm a futures guy, and I'm addicted to trading things like crude oil, because I can call up the crude oil price, the heating oil price, the gasoline price. I can call up the curves. I can call up the crack spreads, and I can get a crystal clear picture of what's going on in gold and in oil. Right. There is no such setup in Bitcoin yet. Right. So I'm figuring out the things as an old school macro trader that I can latch onto, that sort of figure out what the levers are in this new trading vehicle that we're all experiencing. And the one thing that I noticed was that no matter which direction Bitcoin was going, the inflows were massive, right? If it went up, there's inflows on the week of $400 or $500 million in inflows. If it went down, there were maybe $150, $200 million in inflows. If it got slaughtered, maybe there were only $50 million in inflows, but there were corporate inflows. And so what that told me was that there is an agenda to buy Bitcoin, that a sort of hidden agenda in the corporate institutional world that was way bigger than I thought it would have been. So just by getting that read that people are filing money into these ETFs, or corporations definitely, because of the size of the inflows now, are heaving money into these ETFs, no matter where the commodity itself goes, that's when I got excited to buy the next breakout. And there was that consolidation down between 60 and 90K during the Liberation Thursday de-risking, if you want to call that big 1,000-point slide in the S&P. And like I postured to my readers, I said, okay, when this thing recovers technically, we're going to buy it, because it's gotten beat up just like anything else, but not as bad as I would have thought. Thinking that the S&P went from 6K to 4,800, if you would have asked me how low did Bitcoin go during that? I would have been like, oh my God, like Jesus, God knows they could have gotten it down to 30K, and they didn't. So seeing where that thing held its ground, I guess in the high 60s, low 70s, or whatever it was, I don't want to feel like looking at the chart. But then for me, buying the blue sky breakout when it broke the downtrend and broke all of the moving averages and went back above them, 50-day, 100-day, 200-day, that's when I got in again. I'm still long and managing that risk. And every day when they post the inflows, I'm like, a kid in a candy store seeing how much flowed into the ETFs that day, because that's where all the money's going. And I understand it because there's that big issue with custodianship of Bitcoin. And so it makes sense to me that corporations are like, that's the ETF. That's what we want to buy, right? We don't know how to hold the actual coin somewhere. We don't know, that much about it or how the custodial side of it is going to work. And please forgive me if I'm butchering that side of the conversation. But I feel like their natural out is to be like, we're just going to buy this like it's another sector of the stock market.
Yeah. No, look, I really appreciate the perspective on this. The reason I wanted to ask about this is because I know you're not a crypto native guy. You're a Wall Street trader, and I wanted to get your thoughts for the audience about but how you're thinking about this asset class and how you're trading this. So, we're coming close to time here, so I wanted to kind of end on that, right? Like, I think a lot of, our audience is a lot of retail investors. They're pretty savvy, pretty sharp, but they're mostly retail. And I think that a lot of people, things we've seen coming out saying that the retail investors kind of treat the market like a casino. They buy a lot of meme stonks and 0-day options trading. What in your mind separates somebody from being just a gambling speculator in the market to being somebody like yourself who's like a veteran informed trader? And how can you, what tips would you give the audience to sort of bridge that gap as they participate in this market in the second half of 2025?
Well, a good question. I don't know if it's a good or a wise ass answer, but the way that I separate myself from the pack is with 35 years of experience staring at the screens in my pocket, right? I've already gone broke a couple of times. I figured out how to lose money more ways than anybody in the world. And now I've gotten a lot better at making it, having gone through those experiences. So trying to figure out the Bitcoin thing, I guess the one thing that it lends me to believe with the massive size of the ETF holders is that these people they understand the risk associated in Bitcoin. And I think that's a really important dynamic. Like, I don't think these corporations are piling in because they don't know that they can get quartered on their position in a volatile Bitcoin move. I think they do know that. And I think that they're prepared to weather it, right? Because I do think that if anything, the corporation, and this is kind of a vibe that I get from talking to some of them or talking to more traders, is that they found something that they want to play against the death of fiat currency. And it doesn't just have to be gold, right? So there's that new optionality. And you mentioned retail being, I don't consider them uneducated, right? What I have very much grown to respect the retail flow in the last 5 or 10 years, right? Because look what just happened during the Liberation Day sell-off. European fund managers puked into U.S. retail. U.S. retail bought it all, and they were calling Europe saying, you guys got any more stocks over there? Anybody got any more U.S. stocks? This is a retail guy online. I'm Interactive Brokers. I'm on Robinhood. I'm trying to buy stocks from Europe, and they have no interest in selling them to me, So that retail force just overcame the entire institutional force. So, and I feel like that is a big driver in Bitcoin, because there's a lot of whales in the space, et cetera. There are guys with a lot of deep pockets and big balls. And so it's an exciting arena to trade in. And I don't know if I get to the point of answering the question, but I guess my point is that the retail flow is no longer something that should just be retroactively faded like we used to do in the 90s or in the early 2000s. You know what I mean? When you heard like retail was chirping away at this, you were like, okay, that's the end, and it's not the case anymore because of the advent of, electronic trading. I mean, there could be a guy on the other side of an Interactive Brokers account that's got as much buying power as an institution in a certain stock on a certain day or in a certain vehicle on a certain day. Why the hell not? So I really respect, there's been the growth of the family office and the growth of all this wealth management and things like that. So I think that retail is a lot more of an educated, longer holder of stocks or of risk than they used to be, if that's fair. Like you used to see things where retail's buying, and the market would sell off 3 or 4%, and there comes retail puking whatever buying they had just done. And certainly like in Bitcoin, like the holders are way stronger than I feel, than I expect all the time.
Right.
So that's one of the, like in addition to retail, maybe they're not as powerful as the institutional buyer, but they're definitely as reluctant to sell. if not more reluctant, right? There's still shades of laser eyes out there that are like, I just listened to Armstrong on Sean Ryan's podcast, right? The CEO of Coinbase, just to, get a little bit of a crypto flavor from him. And he just, over his breath talking about the price of Bitcoin. He's like, I don't know whether it's a 10X or 100X from here, and you're like that's this guy's base case, over Rice Krispies. He thinks it's a 10X or 100X. You know what I mean? So I'm paying attention to that because that guy is on the inside of this trade looking out with, literally the government working against him, with a lot of people working against him. And he's figuring out how to navigate this space rather brilliantly. If you look at the stock price, you can't take that away from the guy. So he's been a great voice to listen to. And I guess that's what sort of opens my mind to the possibility that maybe this thing does go to 1 million, and I don't know if that's right or the right thinking, but you kind of have to think outside the box to trade this thing. Number one, I'm never going to put a price target on that. It's never going to change the way I manage my risk in Bitcoin, because I manage my risk in Bitcoin just like I manage everything else. I don't buy it unless the risk reward really lines up where I can risk 1 to make 3 or something like that. And I don't ever hold the bag in anything. I don't ever get caught holding the bag. That's just not the way my trading system operates. So I may get out of it and get back into it a couple of times, but there will never be a massive drawdown in Bitcoin that I'm standing there saying, no, I think it goes back, so that's kind of how I'm going to survive this trade.
Gotcha. Well, I think that's a great place to wrap up. We're at time here, but so just to summarize a few things, no rate cut from the Fed. We anticipate one way or another Trump will get rates lower. The bull run's not over. You're watching for confirmation on gold, on the 10-year, but you're expecting equities to go higher. Respect retail. Retail's here. They're not going away, and they're not uneducated. Where can we send people to find you online or connect more with you and your content?
Yeah, man, you can follow me on Twitter at TGMacro, at TGMACRO. My website is tgmacro.com. And if I can do, I'm not a really salesy trader, but if I could do a sort of plug right now, there's 1 day left on a $99 1-month trial that I'm doing. And if you stay with it for after the month, you buy the newsletter. And if you cancel within 30 days, you're out. But that's something that the market has really driven to make me do. And we've got a really huge number of trials in process right now. So if anybody wants to check out my note, on the night of July 31st, this $99 sample sale will come to an end.
Awesome. Thanks for sharing that with the audience, Tony. Thanks for joining us today. One final reminder I would like to make everybody aware of is we are launching Milk Road Macro Pro here at Milk Road Macro in August. We're giving away a free membership. So all you have to do is subscribe to Milk Road Macro on YouTube, screenshot that, post it on X, tag Milk Road Macro, and we're going to pick one lucky winner by the evening of Thursday, July 31st. And you'll be able to join us for 1 year free content on Milk Road Macro Pro. This gives you access to myself, our whole macro team, and our Discord, 2 Macro Pro reports a month, and invites to live AMAs with us so you can get in on the conversation on macro. And a final reminder, nothing in today's episode was financial advice, legal advice, or any other kind of advice. This is all for educational entertainment purposes only. So if you are seeking financial advice, consult a certified financial advisor. Thanks so much for joining, everyone. Stay informed, stay educated, stay bullish, and we'll see you next time on Milk Road Macro. Thank you.
And finally, I've got to give a shout out to our partners over at Nexo. Have just partnered with the DP World Tour, one of the leading golf tournaments in the world, 45 tournaments across 4 continents, and they're going to have the Nexo Championship debuting this August in Scotland. So keep an eye out for that, because this is one of those things that feels very marketing talk, but I get super excited because when you think about sports and the crossover with the attention that it has and how many leading global brands are sponsoring massive sports tournaments, it's pretty exciting to see crypto brands sponsoring large sports tournaments as well. So hat tip to Nexo. Way to go, guys. Thanks as always for doing what you guys do in the space. Thanks for tuning in, y'all. Have a wicked awesome day. We'll see you back again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, This show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.